This was supposed to be a video that I made 2 days ago, but I never managed to. I had some technical issues which I've managed to fix now. The thing I wanted to mention and talk about was how I managed to predict and anticipate the whole entire day. I use a 4-hour and I only use fair value gaps. The reason being is because I've got a theory that you don't really need anything but fair value gaps. You only need them to be able to get bias, to be able to get narrative, draw on liquidity. You can use highs and lows for draw on liquidity. But anyways, this happened on the 9th of April, which was around here, sorry. And if we zoom into the price action right there, I will show you some screenshots of me tweeting about it. I anticipated London to be bullish, which was right here. And we can go back to that. I'll show you exactly what was happening. If we go to the 5-minute, which is the lower time frame of which I use. As we saw earlier, there was a 4-hour fair value gap. This is a 4-hour fair value gap right here. Now, alongside of that, we've seen Tokyo consolidate. And as some people do know, when Tokyo consolidates, we expect or anticipate London to reach or sweep one of the sides of Tokyo. If you anticipate the day to be bullish, you would much rather have Tokyo be consolidating and then London sweep its low, which in this case exactly that happened. We can see a sweep here. That was a London exactly. The indicator here is precisely within London. The time has changed, by the way, so it does show different times, but regardless, we've had a sweep of Tokyo and it's tapped right into the 4-hour fair value gap. I've been using this step-by-step process to determine my bias back to back to back. I've also got a lot of data that I'm working on, and this has worked a lot. It's worked a significant amount of times where price does this. It doesn't necessarily have to take out Tokyo's low or high. Often it does do that. The times that it does, it makes the setup a lot more probable. But the point is that we're on the 5-minute, we see London retracing down to somewhere, and as we saw on the higher time frame, that somewhere was a 4-hour fair value gap right here in between the 3 candles. My next step process or thinking step would be, do we get a displacement? And in this case, yes, we do. Now, from my backtesting data, the displacement does not have to be through a fair value gap. However, it's very, very favorable if it does. So right here, there isn't really a clean fair value gap. There is one there, but that's after a retracement happens. So this candle right there is the disrespect of that fair value gap. But the point is that when you do reach a higher time frame like this, you'd like to see a displacement. And my definition of displacement is either disrespecting a gap on the left or creating a gap on the right, which is this price action right here. And also, just to clarify, even if there isn't one on the 5-minute here, I can almost guarantee it that there's one on the 1-minute or the 3-minute, whatever. That's how the fractional nature of the market is. When you don't see it on this time frame, there will be one on a different one. That also goes hand in hand with my theory that all you need is fair value gaps, because you can use them to get bias, you can use them to get the confirmation, which in this case is the disrespect. But anyways, once that happened, and this isn't the first time that I've come across this, I anticipated London to push up, and it did. It created a fair value gap. Now, I would call this an expansive fair value gap. It expands with 3 candles and it doesn't come back at all. It doesn't retrace. When that's created, the first thing that I would do is anticipate a move back into it. Now, I'm still collecting a lot of data for this, but my data already says that the price retracement would usually be at least in the middle of that fair value gap more than often. Don't get me wrong. I'm not talking about this in a way of look, it worked, like see, it can work, because I understand this is replaying back, but like I said, I'll show you the screenshots of me talking about it, and this is exactly when that happened. This is precisely when I was talking about that. It was just about there when I said that I anticipate Euro to be bullish in London. That would be your entry, which would be the middle of that fair value gap. And if you think that this is cherry picking, that's totally fine. I understand, but the reason why it's not is because I've called it out. And I've used this for the past, I think, month or so every single day. And more than often, it does work. I've also got a bonus little thing to show you besides this. So anyways, price enters. Where is the take profit, right? Where do you put your take profit and where do you put your stop loss? Typically, the stop loss would have to be, or typically you'd want it to be within the fair value gap. because once we enter it from my data, price action tends to respect the fair value gap more than disrespect it. By that, I mean it just wicks away. So from my experience and data, I would have to conclude that a stop loss would be safe within that range. So just under this low and within this section. Now, typically my safe spot would be 5 to 10, maybe 6. It depends on what's on the left as well, which there is a low, but in this case, it isn't that relevant. The relevant part of me explaining this is just understanding price action and movement. Now, remember, I haven't mentioned any breaker block, which there is one here. I haven't mentioned any mitigation block. I haven't mentioned any order block because I don't need any of that. None of those things would exist without the creation of a fair value gap first. So as I was saying, the take profit, where do we place it? Again, from my data, the opposing fair value gap on the other side of the matrix, which would be from discount in this case to premium, which is this fair value gap is in discount. And then we've got this one above it on the left, which is the next one. Typically, if there is one within the range, is a lot more easier to reach. But in this case, it worked out perfectly fine. But as you can tell, there's one on the left right there, which I had anticipated and I did tweet about before I even reached it. I was around here when I said the target was minimum 8663, right? So that's where your take profit would be. Now, the question is, okay, if the take profit is within that gap, where exactly, right? So once again, from my data, the safest spot to put it is at the very beginning of it, perhaps even right below it. That's my understanding of this price action. Perhaps you could call it model or whatever. And as you can tell, price did reach into it. This was one of the best price deliveries I've seen. And like I said, I have seen this happen before and I'd like to make more videos about it because it's something I'm developing and I'm working towards. But then after this, what I did say on Twitter was that this is a part of which EURUSD tends to reverse. And why is that, do you think? Why did I anticipate a reversal? In the context of price action at that moment, we've tapped into another higher time frame 4-hour fair value gap after getting delivered from one in the discount. So now if you understand the nature, or some people like to say algorithm, I don't really buy into that too much. I just follow, I guess, these stupid candles on the chart and I kind of see what's going on. I don't like to pretend I know better than other people and I know the truth of the market, because my opinion is that the market is subjective most of the times. There are objective factors and characteristics which if you learn you can profit from, but being able to say this is what happened and this is exactly why it didn't happen, I think that's just pure ego and people are pretending they know what's going on. Because I know for a fact most of these traders that teach and mentor, they've never worked in a central bank. They've never worked with somebody that knows how the markets book. They've never worked with someone that has actually quote unquote coded an algorithm for this. They've never done that. They're just assuming and teaching people something that's not even absolute truth, and that's what I'm trying to aim for here. I'm trying to teach you the closest information to absolute information there is. Although that's tough and it's not easy to do just generally with anything in life, I'm trying to do that with this here. So as I was describing, we have went from a discount fair value gap. We have traveled. The price has pushed up, right? I'm going to say that as simple as it gets. I'm going to say that in a very simple way. Price pushed up onto another fair value gap, which is right here. And this is in premium in this case. This one is in discount. Just from being able to eye it out, just from being able to see it. This one is at the bottom, so we are buying cheap. This one is at the top, so you would be selling expensive, right? Premium, discount, premium, discount. Once we have reached into that, what else has happened? A high has been taken out. So this high has what on top of it? As we do know, this high contains liquidity on top of it. Some people call this a turtle soup. I like to call it institutional order flow entry drill, and that's my personal choice because it's just easier to understand. It makes more sense than a stupid turtle soup. But regardless, you can literally call it whatever you want. The point is that we've reached a certain higher time frame location of which we can anticipate shorts from, which is this. A higher time frame 4-hour fair value gap. The 4-hour time frame personally for me is the sweet spot, and in this case we've reached it. We've taken our high after we've delivered from a discount. Once again, based on data and based on my own experience of being able to see this many times, This is a reversal point. It's a potential reversal point. In my opinion, it's a very high probability one because New York tends to either continue a move from London, which is this, or reverse. And in this context, once we deliver from a discount fair value gap, we take out a high and we reach a higher time frame fair value gap. What do you think New York is more likely to do? Continue up? And if that's the case, to where? To this gap over there? And let's see how many pips away that is from this one. From here to there, that's 35 pips. The typical ADR of EURUSD would range from 35 to maybe 50. Do you reckon that's possible? No. So, from my conclusion, that's why EURUSD was likely to reverse that day, and I anticipated that. Once that anticipation took place in my mind, I waited for price to do this. Exactly this. Once again, just like earlier, what do we expect to see when we want a confirmation of an idea that we've got? Typically, a gap here would be preferred. We don't get a gap here. There is a gap here, a tiny one. It does not get disrespected just yet. There is a gap here. It does get disrespected later on. But what's the important part? What's the important gap that we need to look at? Well, the very first disrespect of an opposite fair value gap would have to be this one right here. And by the way, you can use the 15-minute if you really want it for this type of confirmation. I just prefer to use the 5-minute because I do believe it helps me be more accurate. But anyways, as I was about to explain, once again, the exact same thing repeating backwards, which allowed me to anticipate a reversal, right? We've reached over here. My only logical suggestion would be something that I've done myself, which would be a retracement like this if you really wanted to enter within this gap. So what do we see when we have this opposing gap located? We have a swing high that fails and then retraces back down, but it does not respect this located gap right there. And that's a what? That's a disrespect. So once that happens, although this is on the 5-minute, although it's the lower time frame, although it seems like it's a stupid analysis and it doesn't make sense at all on the lower time frame, the context of what I just explained this entire video is what gives me off that bias. But once we have that and we've reached into that space and we anticipate that direction, this is all we need to confirm a potential trade. And the reason why I'm being very slow with my wording there is because what I'm trying to say is that you can get your whole direction and your bias right, but then okay, how do you enter? What's your stage? Where do you place your stop loss? Where do you place your take profit? And that's a very good question. The retracement to the first fair value gap would be an entry, to the second an entry, to the third an entry, maximum the fourth in my opinion would be an entry. The reason why I say maximum the fourth, because once again, based on my data, the fourth fair value gap is the last one within the range of which you can take a trade from. And by that, I mean within the range of premium and discount. Typically, the fifth fair value gap would be within 50% or even lower between the range. You don't want to sell in discount, essentially. So anyways, let me stop wasting your time like most of these people do on YouTube anyways, on mentorships. So in this case, there was not a retracement. So within my rule parameters, it would be difficult to take a trade. However, like I said earlier, there doesn't have to be a fair value gap. If you see a gap getting created like this, and then you see a retracement, that could very well be your entry. You could pretend there's a gap there because, like I said, it's fractional. And if you check price action here, there will be a fair value gap here. And as a matter of fact, I can show you, I can prove it to you. If you want me to highlight this right here, just that part right there. If we go to the 1 minute, we go to that spot, that exact spot that I just highlighted. What's that? That's a huge fair value gap right there. And I know there's the 1 minute. I don't use the 1 minute, but I'm just saying, when people tell you, stick to these systematic rules and always wait for this to happen and for you to see this and for that to appear on the chart, you need to understand, right, that what you see here is based on what the broker is able to give you. If you check EURUSD with a different broker, you're likely to see different price action. And I know that I've given a lot of information in this video, but it all adds up because all of these things matter when it comes to how you view a model, how you view price action. And it takes experience to come to these conclusions, but I'm trying to teach it here. Whether you choose to do that or not, whether you choose to be stubborn and say there is no retracement, there is no fair value gap, that's fine. In this case, there actually is one anyways, which you could have entered from. You just be in a little bit of small drawdown. Typically from an entry like that, from my data, the drawdown would reach around 1 pip or maybe 5. And in this case, from that gap to the top is 2.6. And that's fine. 2.6 pips with like a small lot size or 0.5 risk. That's nothing for your psychology. Once price reaches into there, or even entering off of a fair value gap expanding, it just demolishes and goes down. But now, like we said earlier, what would be the take profit? But just like the question from earlier, what would be the take profit, right? Well, if you remember what I said earlier, from my data, the first opposing discount array, because we've just come from premium, is the least resistant target for price to reach. So in this case, I've highlighted it already and I've expanded it to the right because now we are here. We are in this candle right there. This is New York reversing, right? If we go back to the 5 minute, as you can tell, New York reached that location once again. And guys, this is not random. This is not cherry picked. You can believe that if you want. That's fine. I understand that. I'm still working with this model and I'm trying to perfect it. I'm not the best at this. But from my understanding so far, price tends to move within the ranges and it goes from gap to gap to gap to gap to gap to gap, back and forth, back and forth. The times where you don't see that, it would have to be, and this will come into play later, I'll explain this. The times where you don't see that, it would have to be when a gap is in a different time frame or something is happening which is preventing or changing your expectation, such as news, or a weekly gap or a monthly gap, etc. And now that you watch this video, you probably think that was very simple. It's pretty basic, right? But that's exactly what I've used to be able to go from consistent streaks of losses to now just being able to see some profit within a challenge that I'm taking. I'm managing to turn it around slowly with time, and it's only and simply because of this approach, minimalistic approach of fair value gap, displacement, and where would I take my entry and stop loss location. I personally wouldn't try to trade both of these. It depends on your risk parameters and where you are with your capital, but you can take every trade of which your model shows, and that's very appropriate. There's a difference between over trading and taking your model each time that you can. If your model is there, then take it. That's not over trading. You're trading your rules and your system. If you've back tested that model and you've got a probable outcome, then try and follow that model to achieve the probable outcome. The truth is that every time you see a model after it has just happened, it doesn't reduce the probability of it happening. So in this case, we had it happen from London, 4-hour gap, displaced away, reached another 4-hour gap, and then we had it happen in New York. After taking our high, 4-hour gap, we displaced away. And it's the exact same thing. We reached the same target, back from here to up there, to here to down there, back and forth. And I know it's basic. I know it sounds silly. I know it sounds stupid, but it works. It works. It works so well that in the context of CPI, which was just yesterday, it happened again. Truth be told, I was actually bullish with CPI and I didn't trade it, obviously not. I don't like trading news, at least for the moment. I don't try to trade them. I have traded them in the past. I have made profit from them, but it's not worth it at all. In the context of CPI, we had, once again, a sweep of Tokyo, which in this case, it wasn't within London, it was before London, but we had a sweep of Tokyo into what? The same gap from that context. We had one here as well, but it didn't push up as far. Now, the reason why that doesn't push up as far as we can anticipate it to do, which within our rules, it would be the start of this gap, right? The reason why I didn't get there is because this is between 4 p.m., 7, and then Tokyo starts at 8 or 9 in this case. So there isn't much volatility. Not many people are trading within those hours of New York Stock Exchange, right? Anyways, just to show you that I was not cherry picking, and you can see this happen often and often. And you can see this happen every single day if you want to. Sometimes it happens every single day. Sometimes you have to wait a week. It doesn't matter. Sweep of Tokyo into 4-hour gap, displacement away with that little gap, which does disrespect a gap. And I don't care what anyone tells me that it's small, it's too small, it's not significant enough. It doesn't matter. A gap is a gap. The gap that displaces through that gap, which is this one right here, and then we have a new gap, which is this one right here. And like I said before, typically price tends to come in the middle of that gap, which would be along within this price range, maybe somewhere here, so you would miss it, but regardless, the point is that it works, right? So let's just say that you didn't miss it, which would have to be exactly there, right? Let's just say that you didn't miss it for the sake of me explaining the video. Once again, your stop loss would be within the range of just within the gap, within the 4-hour gap. My range typically has to be 5 to 10 pips, sometimes 6. Doesn't matter, depends on the context. The take profit would be just under or in the 4-hour gap. And as you can tell, just before CPI happened, that trade was possible. I don't care what anyone has to tell me. I don't care what anyone thinks of this. This happens all the time. And then on top of that, guess what happened? We reached into there. We displaced through this gap right here. And there was a retracement. And another retracement. To which the exact same thing happened here, which was kind of tradable, kind of not tradable. We've had a reversal within New York, within CPI, in the context that I just gave. Gap to gap, displacement, displacement. And here's my theory. My theory is that news do accelerate price action and just push towards the intended direction anyways. But the reason why it's difficult to trust that and just trade that is because if it doesn't, right, let's say I did get this direction correctly in terms of my analysis. I was actually bullish that day, but in terms of my analysis of gap to gap, this said bearish, right? But the reason why you want to be careful with this, such things, and you don't want to fully trust it, is because if this does not go your direction, you won't just be able to lose. You'll be able to lose probably double the amount that you're risking, and you won't be able to close that trade until many minutes later, maybe perhaps within this range right here. The whole point that I was trying to make is that all I used was 4-hour fair value gaps. And you can see this happen all the time. It happens right here. It happens right here. It happens right here. It happens where else? This is probably a gap as well, just on the left, and I haven't checked this yet. There you go. There's a gap right there, of which we wick away from, and we just bounce back and forth from gap to gap to gap. I think that's what the market does. I don't think it does anything else. There's other things of which give context in some cases, like order blocks and mitigation blocks and so on. In most of the cases, if not majority of them, price just jumps from a fair value gap to another fair value gap, and you can capitalize on this by understanding displacement, by understanding disrespect, and understanding your entry, stop loss, and target, which I've just given you. If you want to backtest what I've just given you, and then maybe tell me how that works for you, that would be great. But the thing that I've just explained is something that I've just kind of been briefly working on. I haven't been able to fully apply it, but whenever I do, it tends to work more than it doesn't. The times that it does not, it usually has worked prior to that. So for example, let's say that right here, it did not displace away from this gap and it just kept going up. The reason would be because we came from one already. By the way, it's already worked here as I'm talking about it anyway. 4-hour gap, wicking away, we're displacing away from it, and we're reaching the next 4-hour in discount. In this case, right here. And it isn't a mistake. The price retraces away from it and just struggles to go and barge through it. That's not a mistake. It's because that is a target. That is a point of liquidity. That is a point of interest in the market. But anyways, to wrap up, that's pretty much it. I do have a lot more things I'd like to talk about. I would like to say that whether you choose to listen to the things I've said or not, both of those choices are fine. I've been wanting to make this video for a long time, even before it happened that day, because this has happened before and I've been able to call out price movements like that. The reason why I haven't made the video is because I am trying to perfect it. I am trying to get to a certain point with my capital and then talk about these things. But I thought, why not? Why not just talk about it? Maybe I can help somebody. My advice for you when it comes to trading and learning things, not making money, I'm talking about learning things, money will come in time, would be simplify it, stick to a certain amount of rules, and before you apply it, back test it. So in my case, it was use gaps, use a disrespect for confirmation, and use the entry being a retracement to a gap or the 5-minute, and the target being the next opposing 4-hour gap, which in this case would be within this, between these two. And this context I've just explained from my backtesting data occurs a lot more than it doesn't, and it works a lot more than it doesn't. So when you find something like that, or perhaps if you like the thing that I've just described, which you can use and backtest yourself, when you find something like that, backtest it, stick to it, and work your way around it. Because in trading, there aren't many binary things. If you don't know what I mean by binary, is that if X happens, then Y will happen. That's not a thing with trading. Unless you've got insider information, you often won't be able to predict an event with 100% accuracy. I was able to do it here based on probable outcomes. I wasn't able to tell people that. I would never tell people that EURUSD is going to be bullish, London is going to push up, New York is going to reverse. I would never say that, because the probability from the data that I've concluded says within these price sections, price tends to do this instead of that. It does do that sometimes, which is the other outcome, but it does this more than that. And that's why I anticipate this instead of that. And that's all trading is. That is all trading is. Being able to find a probable outcome and following it. I'm still mastering that. I'm still practicing it. I'm still learning. But that's something that I know for a fact. I hope I've informed you and I've taught you something. If it has, let me know. If it hasn't, that's also fine. I plan to be one of the best teachers when it comes to teaching price action. And the main motivation is because I've dealt with many people. I've been taught by multiple people. I've had 2 mentors. I've spoken to many traders. I've watched many videos. I've watched many tutorials. I've got many courses. I've got terabytes of content and tutorials and mentorships, but none of them teach the correct way. The most accurate person that teaches these things is Arjo. I love Arjo. He teaches things in a very, very accurate way. He gets straight to the point. He doesn't talk about random crap that doesn't matter. He gets straight to the point of what moved price, why you should anticipate that, what to anticipate after it, and how to apply it. He talks about that. He gets straight to the point. But yeah, I hope you enjoyed the video.